This screencast is looking at question 2 on the January 2017 exam, AgriTech. So it's an exam question based on Pillar 5 around financial reporting and ratio analysis. So you can make sure you read through the question, particularly the requirements, so you understand what we're going to do as we go through the question. So I'm assuming you've read through it. The first thing I always tell students is read the requirements for an exam question. Always understand what you're asked and how many marks are going for each, because that will inform you in terms of your timing. So in this question, for part A, we're asked, assess the financial performance of FeedPro for 2 years, and you're told exactly which headings to analyse it under. So you have 3 headings: profitability, liquidity, and working capital management. So don't do any other headings, such as investment or debt, because you're not asked for them. Only answer what you're asked. And that's for 12 marks. And then based on A, so they're linked here, and then other information provided, advise Kate on the possible actions to improve the performance. So this is a standard enough type question where you're asked to assess the performance first and then provide action points for going forward to improve it. Part C is asking that James and Kate are due to meet with their manager in the bank next week and they want to be prepared for any concerns. So they are asked to analyse the debt position of the company and outline and discuss the key concerns the manager may have and how they might be addressed. And you have to calculate extra ratios here. So in this case, you're going to be asked to do the debt-related ratios. And then part D and E are more non-financial factors, so other factors from the narrative in the question for 8 marks, and then typically a little add-on piece at the end around a company's annual report and what's in it. All right, so the key thing to understand at the start is 50 marks for question, you have an hour to do the question. That's how the exam works. 2 hours, you do 2 questions. And roughly how the timing works is 120 minutes for 100 marks. So around 1 minute or a small bit over 1 minute a mark is your rough gauge in terms of how long to spend in each section. Now you may want to leave a buffer at the start and the end, so you have to take a small bit off. But you need to have that understanding in terms of how you're going to approach the questions. So for part A and B then, they're very much linked and we'll do them together. You have 20 marks, so around the 20 minutes roughly to do this. Right, so if we go open and we look at the question, and again you'll notice now for exam standard questions there's going to be a lot more narrative. And once you've read the requirement, it's important you go through the narrative, use your highlighter or red biro on your exam paper, and make sure to take a note. God, I must remember that for again, or I wonder why I'm told that. So I'm assuming you've read through it, so I won't go through it line by line. But essentially the background here is AgriTech is an agribusiness group. They have a number of different streams of businesses, one of which is FeedPro. FeedPro is the animal nutrition business, and of course this is the problem child of the group. They're not happy with the performance. And they have a review going on at group level about what they want to do, and a lot of people are thinking that they should get rid of or dispose of the FeedPro division. Hence why you're doing the performance analysis. And the bank, of course, has another issue that they're worried about the overdraft. I think here they're worried about the financial performance. And they also have a covenant, a condition that if interest cover falls below 3, it will be in default. And the bank are concerned that the company FeedPro is declining, despite the animal nutrition industry growing at 3%. So read the context there. And they're giving you other information then about FeedPro, as well as telling you the company is thinking about listing on the stock exchange. Hence, that's why it's worried about the annual report. So there is a lot of information there, and that's where you're going to have some of the time you have to invest in the narrative. You'll see from past exam papers there will be a bit of narrative because you have to use that in the question for these types of financial analysis to tell the story. So you'll have the financial statements, so you have to use these numbers and the narrative to inform yourself what's going on. So we're given the income statement for the year and the statement of financial position. Now, although you're not directly asked for a high-level overview, I typically always advise students have a high-level view of the financial statements and jot down 3 or 4 key points about what's going on, because that will be very helpful when you start discussing elements here to pick up some easy marks. Because if you jump straight into the ratios, you'll get lost in the detail and you won't see what the actual story is. So in the case here, this company is clearly declining in terms of revenue. It's gone down about nearly 10%, even eyeballing it here, about 450k, which is worrying when we know from the narrative the industry itself is growing at 3%. And so that's a solid point, and I put a star there or something like that to remind myself again. So I've highlighted that decline. So I just highlight it here. as we go down, so gross profit has fallen, which we'd expect because our revenue has fallen. But we want to see, has it fallen disproportionately, or what does the ratios tell us? There's something going on with some of the line items here. So wages and salaries have increased, dramatic decrease in advertising, increase in interest, and an increase in other expenses. So if something looks funny there, given the context of our business is declining, why would wages and salaries be going up? Why would other expenses be nearly doubling? So again, you can start to think about or get the juices flowing about the comments you might make when you get to the particular question. And of course, the net profit, we're still profitable, but it has declined. So again, that's another important point, that it's still profitable, but it's rapidly declined since 2015. In the statement of financial position, at a high level, what are we looking for? Well, significant increases in inventory and trade receivables, which to some extent we think is unusual, given that the business is declining. So unless we have a better reason, which we're not told, why are you increasing inventory so much and trade receivables, given that you've made less sales this year? So perhaps there's something going on with how they manage those. Cash is now gone and we have an overdraft. So of course the bank is definitely going to be concerned about that. And again, we're not sure what our overdraft limit is, but again, it'll be an important point to note in any bank discussion. So we still have 2 million debt, and notice this is in there for a reason. In 2018, meaning in 2 years' time, it's repayable. Again, that's going to be a concern for the bank that you may bring up in Part C. So we're just trying to show you, getting to think, even before you jump into the ratios, get the highlighter out, do an eyeball test as we call it, just to see what are the key issues that we know we're going to bring up when we get into the nuts and bolts of the questions. Okay. So as we go through then, we're asked now for 3 different pillars: profitability, liquidity, and working capital. Notice here I don't tell you the ratios. Some questions I give you guidance as to ratios. Other questions, part of the assessment is, do you know which ratios you should use? Now, some students will say, well, how many do I calculate? Well, I'd roughly gauge it off how many marks. You have 4 marks for each pillar roughly, so I wouldn't be doing more than 2 or 3. Right? But you pick 2 or 3 good ones that will give you a broad overview of what profitability is. So how I'd lay this out is my first page of my calculations, or maybe leave 2 pages, will be just calculations of ratios. So ratio calculations. So why I tell you to leave the first 2 pages is you don't have to judge then how far back you should start at the back of the book. If you leave the first 2 pages, I don't mind if that's an appendix. Then you know, well, I have enough space there for my ratios, and then I can start my formal question. There's nothing more messy than doing narrative and doing your calculations at the same time. It gets very messy and hard to read. So for profitability, you're asked to do it for 2 years. So you're going to have 2016 and you're also going to have 2015. So in terms of the choice of the ratios, I mean, you do have a number of ones you can pick from. You still have to pick some that are going to give you information. So revenue growth, although it's typically, you probably wouldn't classify it as a profitability ratio, it's useful to calculate. Has revenue grown or declined? And of course, we can only do that for 16. Then I'd likely do my gross profit margin. I will show you net profit margin as well. And typically, I always tell students, you typically need one of return. So either return on capital employed, which is the one we'll do, or return on shareholders' funds. So you want profits as a percentage of revenue and profits as a percentage of the capital invested, usually one of both. So if you're not told, I'm trying to assess you on which ones you should do. Okay. And when you're showing your revenue, you don't need to show the formula. I'm happy enough if I can see the numbers where they're coming from, you'll get your credit. So in this case, the revenue growth, how do we calculate it? Well, we get the movement. So the movement here is minus 4950 plus 4455. Essentially, the movement is a decline of 495. So you've gone down 495, that's what I've gotten, over the 2015 4950. So it's fallen 10% over the period. So 10% decline. So again, that's one ratio that's useful. So it actually declined 10% even though we know the industry has increased or grown by 3% this year. So that's one relevant ratio. For gross profit margin, what we're looking at here is we know gross profit has declined, but we want to see as a percentage of revenue, has it gone up or down? So in 16, it's 785 over 4455. And in 15, it's 990 divided by 4950. So I'll just put these as percentages. So what you're saying is the gross profit margin was 20% last year, and now it is 17.6% this year. So not only has it decreased in euros, it's also decreased relative to the amount of sales you made. So you've been less efficient in your pricing or less efficient in your direct costs, which are in your cost of sales. So movements in gross profit margin are only explained by these two line items. But we know there's funny movements going on here as well at the expense line. So another one to capture these movements as well is to do net profit margin. So in 2016, it was 85 net profit over the sales, 4455. So net profit margin is net profit over revenue. Whereas in 2015, it was 293 over 4950. So if I just do them the same format, it was 5.9%, so nearly 6% net profit last year, declined by 2/3 down to just under 2%. So again, that would be worrying. It's a big decline relative to where it was. And again, we can see some of that explanation can be these funny movements in the expense lines that need to be investigated further. So we can know advertising has fallen off a cliff. Perhaps that explains the revenue movement. So you're starting to try to piece things together based on the narrative that's given in the question. And finally then, ROCE is return on capital employed. And how you calculate that is operating profit. So just be careful here. It's profit before interest and tax. So, and that's why there's a trick in this question. It's the 95, add back the 110. So your operating profit there is 205. Right, so that's why we're adding back the 110 for interest, divided by the capital employed, which is your debt plus your equity. In this case, it is 2 million plus 2085. So that was a tricky one. You have to add back your interest because you want profit before interest and tax, and you put it over the capital employed. So it's about 5%. And if I do it here, your profit before interest and tax, I'll just put a bracket on it, is 345 plus your interest of 60 divided by the capital, which is debt of 2 million plus equity of 2 million. So it's 10%. So your return on capital over the period has halved. And again, the main driver of that is your capital really hasn't changed. It's still 4 million odd both years. The main driver there is the fall in your profit. That's what I expect students to pick up. So you can do them as a little table, maybe in your appendix. And what I would do then is structure your answer, a paragraph, a couple of lines on how do you interpret profitability. So assess the financial performance. So you can see in the solution that's up there on loop, I do a heading, a little table of numbers, and then a couple of key points. And I'm not looking for big essays, I'm looking for points that students link back to the facts of the case. So I won't write them down here, but I'll just talk through some of them. A student will link back to say worrying performance of revenue growth in the context that industry growth is 3%. You're told that in the narrative. Likewise, you're also told feed volumes are down by 5%. So we know maybe some of the revenue is down to a volume decline. But of course, that doesn't explain all of it. So we've also had a price decline. So again, we're just trying to piece together what the driver is. So as well as fall in volume, we had a fall in value. Both gross profit margin and net profit margin are down. Some of that is due to issues around cost of sales, which we don't have enough information about. But we know a lot of the part here is due to strange movements and expenses that need further investigation. So why has wage and salaries gone up when we have a 10% decline in business? Why is other expenses nearly doubled? Interest, to some extent, some of that can be explained probably by the increase in the overdraft. But a more worrying one you really need to investigate is, why has there been a 110 fall in advertising and marketing? And the good student will link that back to maybe that's a big driver of the fall off in marketing, or fall off in sales, should I say. So you see, you're trying to piece things together. All I want is succinct bullet points. And where you gain or lose marks is your ability to link it back to the facts of the case. I don't just want to say gross profit margin has fallen from 20 to 17.6. I can see that, but I want you to see, can you help explain that with what's going on in the question? Okay, so that is your profitability. The next one you're asked to do, similar approach and keep it structured, is liquidity. So liquidity, there's really only two ratios you can do here. Liquidity looks at the ability to pay your debts as they fall due. So your short-term cash flow issues. And we have the current ratio, and we have what's called the quick ratio. Another word for the quick ratio is the acid test ratio. And what essentially you're looking at here for 2016 and for 2015 is the relationship between your current assets and your current liabilities. So be careful to take the right one here. Current assets in 2016 are 1.325 million here, divided by 990. So it's 1.34 there is your current ratio in 2016. So for every €1 you have in liabilities, you have €1.30 in assets. In 2015, it was 1107 divided by 450. So 2.46. The quick ratio, the only difference is you do not include inventory. So you remove inventory from the assets on the basis that it's not a very liquid asset. You can't convert it into cash very quickly. So here it'll be 580 divided by 990. And here it will be the two of these added together, which is 957. Sorry, that's wrong. It's the trade receivables and cash added together, which is 557 divided by 450. So in terms of commentary, so the quick ratio is a more severe test of your liquidity because inventory is taken out of it. So what we're looking at here is the usual ballpark rules, unless you're given industry averages, is you want your current ratio to be 2:1 and your quick ratio to be 1:1. So last year there was no liquidity issues, but both have deteriorated this year. So that's what I expect some students to say. Both have deteriorated, and also both are below the ideal of 2:1 and 1:1. So that's two very good points. The other thing you might say then is, well, what's driving that? The main driving factor of that is the movement in cash to an overdraft position. So you've gone from having an asset of cash to a big overdraft, and your trade payables has gone up as well. So that's driving the increase in the current liabilities, which is lowering your ratios. So it's not overly difficult if you try and link it back. And of course, think about that's going to be very relevant for the bank when we talk about the bank as well, because they're worried about your ability to pay your debts as they fall due. And currently, it looks like we're going to have a bit of trouble paying our short-term debts. Okay. And a very good student will link and say, that could fall on to 2018 when we have to refinance our loan. So the bank may be very concerned about that as well. The final one then in part A is working capital management. So working capital management. And the ones that we look at here are how you manage your trade receivables, which we call trade receivable days, your trade payable days, and your inventory days. So what these are is they're essentially crude measures of how effective you are at managing what we call your working capital. So the money you've invested in the day-to-day running of the business. So the money tied up because customers owe you money. The essentially source of finance you're getting because you owe suppliers money, so you haven't paid them yet, you're taking trade credit. And how much money on average, or how many days on average, is your inventory outstanding. Because the longer you have inventory outstanding, the more money is tied up in that. So we look at 2016 and 2015. So again, remember, you need to know these formulas, so try and pause it and see can you calculate it based on your knowledge of the formulas. So go back, have a look at the formula, and then see can you calculate it yourself. So in trade receivable days, what we look at there is on average, how many days does it take your customers to pay you? You do trade receivables for the year, divided by the revenue, times 365 to get the number of days. So it's trade receivables divided by the revenue times 365 is about 47.5 days. Whereas in 2015, it was 407 divided by 4950 times 365. It took your customers 30 days. Right, so again, we'll come back and comment at the end, but first thing is to be able to do the calculations. Your trade payable days are trade payables, which are 550 over your cost of sales 3670 divided by 365. So this is telling us on average how long does it take you before you pay your suppliers. How long does it take you on average before you pay your suppliers? 55 days. And last year it was 450 divided by 3960 times 365. It took you about 41 days. So you're taking now longer to pay your suppliers. And again, we'll interpret that as we go through. Final thing then is inventory. Similar logic. On average, how long is inventory held? It's 745 over your cost of sales 3670 times 365. So on average, inventory was on hand for 74 days. Whereas in 2015, it was 550 divided by 3960, which is your cost of sales, times 365. It was only on hand for 50 days. So in terms of commentary, what we're looking at is, well, in 2015, it was on average, it was taking your customers 30 days to pay you. Now it's taken 47.5. So again, that is deteriorating performance. It's taking customers longer to pay you. That means you're losing out on that money. It's a cost to you if you're not getting the money in quicker. And good students will link this back to the fact that you're told here all sales are on credit with a company policy of 30 days. So clearly someone is not managing it if they're not abiding by the company policy. So it suggests there's loose working capital management there that needs to be improved. On the other hand, your trade payables, you were taking 41 before, now you're taking 54.7 days to pay. So at a high level, you could recognize that's good because the longer it takes you to pay, it's less expense to you. You don't have to pay up front, so you're saving on the cost of finance. However, a good student might point out you'd want to make sure you're not damaging the relationship with your suppliers. Often the time when trade payable days increase, it's not because there's a strategic decision that you've negotiated an extension, but it may be due to necessity because you don't have the cash to pay. So you want to watch that you don't read this too high level. While that looks good from a working capital management perspective, if that is because you don't have cash and your suppliers are now hounding you for money, you may be damaging the relationship, and more importantly, they may start to charge you more for goods going forward, which will impact on your profitability. So again, it's important you try and read into what might be happening. The final thing then is, on average, you're holding inventory 24 days longer than last year. Now again, you'd question this in terms of, well, should be review stock, and also why are we holding so much stock for such longer if we're not making those sales? So it suggests stock management or inventory management needs to be looked at. So you can see the general approach for part A is you give a nice structure in an appendix, do the calculations where I can see the numbers, so I can see where you're getting the figures from. Because if you just stick down a number, I can't give you credit if it's wrong. Whereas if it's just a slip, I can give you some credit. So do those in separate sections and then give nice, concise commentary linked to the facts of the case. So in part B, a lot of the stuff you've actually answered already. So possible actions to improve. I would take 8 marks. You're probably looking for 4 solid points that are discussed in 2 or 3 lines. Right, so what are the key things we might take out? So there's a number of acceptable answers here. One will obviously be you need to review the decline in revenue. Right? You understand that 1, So there must be an examination of what the cause of that is. One obviously is to do with volumes, but a further understanding has to be around, well, why is the industry growing at 3% when we're declining by 10%? So a further examination of that, and in particular you might also link that to the dramatic drop in advertising and marketing. So it's a key concern that needs to be investigated further. Okay. Next one is, you might suggest, well, a further examination of all the expenses needs to be done. Wages and salaries and other expenses in particular. Why are these increasing in the context of a declining business? So just nice, succinct points. There's a lot of overlap with Part A, but that's intentional. The next one will obviously be around the management of liquidity. You're clearly in a difficult position with your short-term debts, and you could have funding issues coming up. So you need to review your working capital. If you have unnecessary cash tied up in inventory or in trade receivables, and you need to review, as you will in Part C, your overdraft position. How sustainable is that, or are you coming close to a bank limit? Okay. And finally then you might talk a small bit about the working capital, how you might improve this. So you need to look at your listings in terms of who owes you money and how long they've been outstanding. I need to follow up on those, anyone that's in breach of the 30-day credit policy. You also need to ensure that you're not damaging relationships with your suppliers, so confirm that everything is agreed and you're not overdue in any supplier accounts. And then of course, as we mentioned before, a full check of stock to ensure there's no aged stock or obsolete stock on hand that is driving up those inventory days. So you can see it's very pointed. I don't want big long essays. I want to say very much linked to the information. What exactly would you do? And you'll see that in the suggested solution as well. Part C in this question is now focused. We looked at 3 pillars up here. It's now focused on the debt pillar. So what they want you to, question wants you to do is analyze the current debt position and then outline and discuss the key concerns that the bank would have. And you're asked to calculate at least 2 relevant ratios for each year. And of course, if you'd studied the area, you know there are only 2 ratios anyway. It's the gearing ratio and interest cover. So you could do interest expense as a percentage of revenue if you wish, but the 2 main ones always are gearing and interest cover. So if we do a brief calculation of those, and we'll talk about the small points you might make. The gearing ratio is your debt figure, which we know is 2 million in the question for 2016, over debt plus equity. Over debt plus equity, which is shareholder funds. So essentially what gearing tells us is what percentage of the business is financed by debt. What percentage of the business is financed by debt? Here it's about 49% in 2015. Of course, as you can see, it's going to be exactly 50%. Because you have 2 million debt and 2 million equity, therefore it was 50% financed with debt. So I'll just put those as percentages. So what we're saying there is half the business is funded by debt, which itself, it's getting towards being highly geared, but it's not overly geared. So it's not 60, 70 or 80, it's still 50. So it's not a major concern. Again, you would like to know what the industry average is just to get a better idea, but you've only a certain amount of information in the question. Interest cover, on the other hand, is how much profits do you have to cover the interest paid? So what times profits? And again, be careful here. The formula for interest cover is profit before interest and tax, which here will be 95 plus 110, because you want to add back interest, divided by the interest. So you're saying, I have about 1.9 times my interest cover in profits. So I'm nearly double the cover. So profits could nearly have before I wouldn't be able to pay my interest. So that's what essentially it's measuring. It's your profit before interest and tax divided by your interest. How many times profits do you have to cover your interest? In 2015, it was 345. Add back your interest, 60, divided by the interest, meaning you had 6.75 times interest in profits, or 6.8. So you were very comfortable in terms of the ability to afford that interest on an ongoing basis. So that answers the first part in terms of calculating the ratios. Then you're asked to analyse the position and discuss the key concerns. Well, from a debt position perspective, they're not overly geared, but they're nearly there. So they're relatively stable. However, there will be a big concern with interest cover. Interest cover has fallen from 6.8 times down to under 2, to 1.9. What's driving that? Well, the key things that are driving that is a fall in profitability coupled with a nearly doubling of interest. And that's more likely because you have such a big overdraft now, it can be very expensive for interest. The other big thing that we wanted students to realise is a big concern for the bank now will be, and for Kate, you're actually in breach. If interest cover falls below 3, so again, note you're told information in the question to use it. So always come back to it. If interest cover falls below 3, you're technically in breach of the loan and it can be called in. So therefore, that's going to be a big concern for the company. So in terms of the concerns for the bank, what would they be worried about? Well, one is the low interest cover, which of course is linked to the low profitability. They'll want to see how are you going to turn the business around, and you will link that back to the issues in Part B. They're also going to be concerned around the overdraft position. They'll want to know how are you going to rectify that, and they're more than likely want to be able to present it with a cash flow budget and forecast so they can assess the likelihood of that being rectified next year. The other main thing they'll also be concerned about is your ability to pay back the loan in 2018. So it's due for repayment in January 2018. So again, you'll have to address with a cash flow forecast, what's your plans for refinancing and how likely do you think that's going to be successful? So they're the main concerns the bank is going to have around the interest cover, the breach in the loan condition, because it's under 3 times, the declining profitability and declining revenue in the business, and the decline in liquidity. All those things are valid answers. And again, remember, you have 10 marks, so you're talking about 10 minutes. So roughly around 10 minutes to answer that question. But as much as possible, link it to the facts of the case. Now, the last two, I'm not going to spend too much time on, particularly Part E. You can look at the solution for that because it's somewhat general. And note there, you could have started with Part E in the question because it's somewhat isolated to the rest of the case. So always watch out for that in terms of the sequence of where you want to start the question. But I'll leave that for you to have a look through. The other important one here is identify and discuss any other relevant factors the management and board should consider before deciding or finalising a decision regarding the future of FeedPro. And what I'm looking for here is not a checklist. There's always going to be enough information in the question to relate back your points. And always ask yourself, read through the narrative again and say, well, I haven't actually used that before, or that can be actually a very valid point in terms of making this decision. So some of the key things that would have been directed in the question were, for example, you're told here that the group are concerned about the performance here, and the board as a whole are going through a full review of its strategic plan next year. So one obvious thing is, well, why would you preempt the strategic review by deciding to sell off FeedPro in 2016? So some month until the strategic plan as a whole is done, you should really hold back until you get a broader idea of what the plan is for the group. Likewise, if we see here, technically the bank has control now. Because you're in default based on your interest cover, you really have to discuss what the bank wants. So that's going to have a big influence in terms of deciding what's going to happen with the FeedPro division in the future. Another good point that some students raised was this one, and that's why it was in here. 40% of FeedPro's customer base are farmers who supply their milk processing. So the likes of Glanbia, etc. were the same. You're selling feed to the farmers, and the farmers are supplying milk to a different division. So what happens if you sell FeedPro? Will there be unrest with the farmers who now have to deal with someone else and they may lose discounts? And do you have a synergies because you have somewhat of a closed loop as a business, because you know where the feed is coming from and you know the milk is coming back into your processing as well. So that is very important in recent times. And the final key factor that hopefully you might have spotted was, well, if this company is thinking about doing an IPO, i.e. listing a stock exchange, you want to be cognizant of what any disposal or not of FeedPro will have. So by keeping FeedPro, will it be a lag on the business, or drag should I say, that'll depress the price? Or if you sell it, will it give a bad signal to the market that you're not really sure what your strategy is? So you have to be sure in terms of what your IPO strategy is and the impact any disposal possibility of FeedPro will have on that as well. So there was at least 4 very solid points there around the bank being in control, around the group strategic review, around the interdependency of the feed business and the milk business, the other division in the group, and around the IPO itself. So you can see there was a lot of scope to integrate the facts of the case into your answers. If you come up with generic stuff, you'll get a line put through it because there's plenty of material there to work with. Right, so again, I'll leave part E for you to have a look through. It's somewhat general, and again, it's just test your knowledge of what is in an annual report and the main financial statements, etc. So overall, that's a past exam question on financial statements in terms of being able to read them and also ratio analysis. The key insights you should take away is the ability to read the narrative and link it back to the calculations. You can't see them as separate. And for any narrative questions such as identify other factors, you need to be able to link every point back to the facts of the case. Anything that's a generic type checklist point is unlikely to score credit in this exam. So that was January 2017, question 2, AgriTech.